Hello everyone, welcome to EduTap and welcome to the Finance 360-degree session. And this session, I can truly say it is very important for your coming regulatory body examinations. This is regarding the revised economic capital framework. So RBI has taken a huge step and the RBI has done the revision in the economic capital framework. That is a very important framework of the Reserve Bank of India, and I think you will recognize it with the name of Bimal General Committee gave the recommendation about the economic capital framework. So we will discuss about this revision that has happened in the economic capital framework, as well as we will discuss that in the 616th meeting there are major decisions that has been taken in regards to the dividend transfer to the Government of India, as well as the contingent risk buffer that will be maintained by the Reserve Bank of India. So this is very important, I can truly say, and you will see that how important it is once we discuss the data points and once we start discussing it. But this session is something that you should not miss, because there is a huge possibility for a descriptive or objective question to come from this news article. Okay, so let's start with it. And let's start with this very important session. But before that, give me a thumbs up if I am clearly audible and visible. So good morning to all of you, and give me a thumbs up if I am clearly audible and visible. And before moving forward with the topic, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, as well as do join the YouTube channel so that you continue getting these videos, as well as do join the Telegram channel where you will get the PDF of the session. So the link for the Telegram channel is provided in the description box below. Okay, so in the Telegram channel you will get the PDF, and the link for the Telegram channel is in the description box. So let's start with the first topic for today, that is, okay, am I clearly audible and visible? Why do it show that the session? Okay, so here, okay, everything is fine. So we are first starting with the highlights of the revised economic capital framework of the Reserve Bank of India that is approved by the Central Board. So the Central Board of Reserve Bank of India has approved the revised economic capital framework. Okay, and the highlights have been given by the Reserve Bank of India in this regards. So in the 578th meeting of the Central Board of the Reserve Bank of India, so in the 578th meeting of the Central Board of the Reserve Bank of India, this was held on August 26, 2019. The Central Board had adopted the economic capital framework as per the recommendations given by the Bimal Jalan Committee. So the Bimal Jalan Committee, this was the expert committee. The Bimal Jalan Committee, this was the expert committee that was established to review the existing economic capital framework of the Reserve Bank of India, and the Bimal Jalan Committee, that was the expert committee, gave the recommendations regarding the economic capital framework, and these recommendations were accepted by the Reserve Bank of India in its 578th meeting in 2019. So basically, Bimal Jalan Committee, it was established to review the economic capital framework and to provide recommendations regarding the economic capital framework. Dr. Bimal Jalan Committee provided the recommendations, and that were adopted in 2019 by the Central Board of the Reserve Bank of India. As well as the expert committee, that was the Bimal Jalan Committee, it also recommended that the framework, economic capital framework that is recommended by the Bimal Jalan Committee, it was said that even this economic capital framework should be periodically reviewed every 5 years. So the Bimal Jalan Committee said that, okay, we are providing the recommendations regarding the economic capital framework, but whatever recommendations we have provided, whatever economic capital framework we have provided, even that should be reviewed every 5 years. And that's why now the RBI has taken the review of this economic capital framework that was recommended by the Bimal Jalan Committee, and that was adopted in 2019. Okay. So in line with the recommendation of the expert committee, that was the Bimal Jalan Committee, the Reserve Bank of India has undertook the internal review of the framework of the economic capital framework based on the experience that has been gained with the operationalization of the economic capital framework, developments in the external operating environment, and the changes in the asset portfolio of the Reserve Bank of India. So basically, if you try to see, so okay, so here, see what happens that the economic capital framework, this is a very important framework of the Reserve Bank of India, because according to this framework, there are the guidelines that are laid down that how much capital buffers the RBI should be maintaining. So according to this economic capital framework, there are the capital buffers, the contingent risk buffers that the RBI maintains, as well as according to this framework, but after maintaining the contingent risk buffer, whatever surplus is left with the Reserve Bank of India, that is transferred to the Government of India. So economic capital framework, this is the framework according to which the contingent risk buffers are maintained with the Reserve Bank of India, or the RBI decides about the contingent risk buffer, as well as according to this framework, whatever surplus is left after that, that is transferred to the Government of India. So this economic capital framework is important for maintaining the contingent risk buffers and the RBI deciding the contingent risk buffers, as well as it is important from the perspective of the transfer of surplus to the Government of India. So this is a very important framework of the Reserve Bank of India. Now, as per the recommendation of the Bimal Jalan Committee, the Reserve Bank of India has undertook an internal review of the framework based on the experience that the RBI has gained in regards to the 5 years of operations of the economic capital framework that was recommended by the Bimal Jalan Committee, and the developments that has happened in the external operating environment, and on the basis of the asset profile of the RBI has undertaken the review. The outcome of the review was considered by the Central Board in its meeting held on May 15, 2025. So recently a meeting was held of the Central Board of Reserve Bank of India, in which the review was done, or in which the consideration was given regarding the review. So the outcome of the internal review, this was considered, this was seen in the Central Board meeting that was held in May 15, 2025, and the revised framework was approved by the Central Board of the Reserve Bank of India. So this is the idea, that the internal review was recently undertaken and the Central Board approved this review. It was noted by the Central Board that the existing ECF had met its objective for the 5 years. It has worked very, very well. It has met its objective because as per the existing economic capital framework, the RBI was able to maintain enough of the buffers, and the RBI was able to maintain, or RBI was able to transfer a lot of surplus to the Government of India also. So it was noted by the Central Board that the existing ECF had met its objective of ensuring a resilient balance sheet of the Reserve Bank of India, where the RBI was maintaining enough of the buffers that were required by the Reserve Bank of India, while maintaining healthy transfer of surplus to the Government of India also. So both of the objectives are met of the ECF, the economic capital framework that was recommended by the Bimal Jalan Committee. Accordingly, it was decided to retain the broad principles, because the ECF that was recommended by the Bimal Jalan Committee has worked very well, and that's why it is said in the internal review that we are going to retain the broad principles of the existing economic capital framework with no major changes in the risk assessment methodology. So you can understand that the previous framework is so good that it is said that we are going to follow the broad principles of the previous framework, as well as we are going to do no major change in the risk assessment methodologies. Certain changes, minor changes will be done. So certain changes have been made with the objective to further strengthen the framework to align better with the emerging risk to the balance sheet of the Reserve Bank of India, and to provide flexibility to the Reserve Bank of India. So the internal review, as per the internal review that was recently undertaken, it was said that the previous ECF framework is very good, and we are going to keep the risk methodologies intact, and we are not going to change the risk assessment methodologies, but we are going to make minor changes so that we are better aligning with the emerging risk that is coming to the balance sheet of the Reserve Bank of India. So the revised ECF, as per the internal review, the revised ECF provides requisite flexibility year on year to the Central Board. So this new ECF that we are going to discuss, so the revised ECF, the economic capital framework that we are going to discuss. So this provides the flexibility to the Central Board in the maintenance of risk buffers, considering the prevailing macroeconomic and the financial factors and the other factors. So there is the flexibility that is provided under the revised economic capital framework, while also ensuring needed intertemporal smoothing of the surplus transfer to the Government of India. So basically, under the revised ECF, there are the dual objectives that are undertaken. So first of all, there is flexibility that is provided to the Central Board of the Reserve Bank of India, so that they can maintain the buffers in a flexible manner, that you will see, it's not like that RBI wants to maintain less buffers. Even RBI wants to maintain even more buffers. Okay, so there is flexibility that is going to be provided to the Reserve Bank of India according to their understanding. They can maintain more of the buffers or less of the buffers. Okay, so the flexibility will be provided to the Reserve Bank of India as per the revised economic capital framework in regards to the buffers that they maintain. The second part is that the surplus, in some years the surplus that is going to the government of India is very, very high. So it is said that the intertemporal, that means in different timelines the surplus should be smoothened out. In different timelines there should be smooth flow of surplus that should happen to the government of India. So that will also be looked after in the revised economic capital framework, that in the coming times also the surplus is smoothly transferred to the government of India. So these are the dual objectives of the revised economic capital framework that was revised as per the internal review of the Reserve Bank of India that was approved on May 15th, 2025. Okay, so maintain the flexibility in the buffers and smooth transfer of the surplus to the government of India. Now, this is the first part that we have discussed. Now we will go forward with the data points and we will understand the data points. But before that, think about it, that RBI, it provides loans to the banks, or it provides loans to the state governments. It provides loans to the various entities. So is there a risk that is involved to the Reserve Bank of India? Is there any risk that is present with the Reserve Bank of India? Similarly, the Reserve Bank of India maintains various currencies. RBI maintains various currencies in its foreign exchange reserves, or RBI has various different currencies, dollars, euro, pound sterling and various other currencies. Though they are quite stable, but still there can be volatility that can come in the currencies, in the foreign currencies. So is there any risk that is involved or that is present here? Any risk that you can think about it? Any risk? As well as the RBI is also buying various securities. The Reserve Bank of India is buying the various securities. It is investing in various securities. It is investing in various bonds and other kind of financial instruments. So is there any risk that is involved here? Is there any risk that is present here? The RBI is the monetary authority. The RBI is the monetary authority. It is at the top of the banking structure, and it also looks after the financial system of the country. So is there any risk involved here to the RBI? Yes, very good. So see, RBI is providing loan to the banks. RBI is providing loan to the banks. So there is credit risk that is involved. That what if the bank is not able to repay the loan? What if the counterparty defaults? What if the other party defaults? So there is the counterparty risk, there is the credit risk that is present. Now the RBI is maintaining the foreign currencies. What if the value of the foreign currencies, what if the value of pound sterling, what if the value of euro starts going down? So there is the exchange rate risk that is present. There is the exchange rate risk that is present, or we can say there is the market risk that is present. So there is the market risk, because in the market there it is risky. The securities, RBI is buying the securities. So again, there is market risk that is present. There is the market risk that is present. That what if the value of the securities go down? What if the value of the bonds, or what if the value of the shares that the RBI has purchased, that goes down? So monetary authority, RBI is the monetary authority. It is also looking after the financial system of the country. So it has the monetary and financial stability risk. Because let's say, like in ILNFS case, the institution, the NBFC, it went bankrupt, or there was the problem that was created by the ILNFS, as well as if any of the bank fails, if any of the NBFC fails, the whole of the monetary system gets entangled in the problem, and there is the like the RBI has to come forward to save the bank or to help the bank out. So there is also the monetary and financial stability risk that is present, where the RBI has the risk that what if something happens to the monetary system or the financial system, the RBI will have to cater to that. Okay, so this is the idea. This is the idea that there are different risks that are present with the Reserve Bank of India. The RBI also is entangled in various risks. Like the banks are, see, it is said that the banks are providing the credit, and that's why the banks are providing the credit, and that's why they have to maintain the capital buffers, right? because what if the counterparty defaults, what if the borrower defaults? So banks have to maintain enough of the capital buffers. Similarly, the RBI is entangled in so many of the risk. The RBI is entangled in so many of the risk. So RBI should also maintain capital buffers. Do you think so or not? The RBI should also maintain capital buffers so that if any of the risk comes, if any of the monetary, so there are four major risks. Okay, there is the credit risk, there is the market risk. In the market risk, interest rate risk, exchange rate risk, all of this comes. Then there is the operational risk in the operations of the Reserve Bank of India. Then there is the monetary and financial stability risk. Okay, so these are the four major risks that the RBI faces, and for these risks the RBI has to maintain the capital buffers. Okay, nice. So now we have understood the basic idea that RBI has to maintain the capital buffers. RBI has to maintain the buffers. How much of the buffers should be maintained by the RBI? So that comes under the economic capital framework. Okay, so the computation of market risk. So first we are starting with the market risk. So the computation of market risk buffer requirement, this is on the basis of the on balance sheet portfolio. So on balance sheet of Reserve Bank of India, on balance sheet of Reserve Bank of India, so all the loans that the RBI is giving, all the deposits that the RBI is taking, so the current transactions that the RBI is doing, the current asset of the bank. So RBI is giving the loan. If RBI is giving the loan, that is the asset for the RBI, because on that loan RBI is going to earn the repo rate, on that RBI is going to earn the MSF rate or the interest rate RBI is going to earn on the loans. RBI is taking the deposits, so this is the liability of the RBI, that is the deposits the RBI will have to return in the future. So this is on the on balance sheet of the RBI, the day-to-day or the normal functioning that it is doing in the present time. Now off balance sheet transactions or off balance sheet consist of the derivatives, because derivatives, they are the contingent liability, they are the future liability that can come in the future. Okay, so derivatives, guarantees, the RBI has given guarantee on behalf of some institution. So what if that institution fails and the whole of the liability comes on the head of the RBI? So if the RBI is giving the guarantee on behalf of some institution and that institution fails down, that institution fails, so RBI will have to the RBI will have to take the liability. Okay, so basically off balance sheet, it consists of the contingent liabilities, the future liabilities that can come on the Reserve Bank of India, like the derivatives, they are the future they are on a future date, and the guarantees that the RBI is giving on behalf of an institution. Okay, so this is the on balance sheet and off balance sheet of the Reserve Bank of India. Clear? Off balance sheet consists of the contingent liabilities that can come in the future, like the RBI has given guarantee on behalf of the XYZ is failing, so it has taken the loan of 100 crores, so the RBI will be liable to pay those 100 crores to the bank. Okay, so this is the idea. Now the computation of the market risk buffer, that means the RBI is saying, as per the internal review, the market risk buffer requirement, so how much of the buffers have to be maintained for the market risk, this will depend not only on the on balance sheet portfolio, but it will depend also on the off balance sheet portfolio. That means before, only the on balance sheet portfolio was seen to take into account the market risk and to maintain the buffers for the market risk, but now it is said that the integrated approach will be adopted, in which off balance sheet portfolio is also reckoned, or it is also taken into account together with the on balance sheet portfolio. Basic idea. The computation of the market risk buffer requirement. So how much of the buffers have to be maintained for the market risk? This will also include the investment that the RBI is doing in the foreign currency asset in minor currencies, So the major currencies are the 5 currencies: the Chinese renminbi, the Japanese yen, pound sterling, euro, dollars. They are the 5 major currencies that are kept in the foreign currency asset. But in the foreign currency asset, the RBI is also keeping some minor currencies, some small currencies of the different countries around us. So even those, like the computation of the market risk buffer requirement may also include investment that is done in the minor currencies. Next is, so this is important, that while the requirement of the economic capital for market risk, so the capital has to be maintained. Buffer means what? The capital has to be maintained for the market risk. This may continue to be assessed, that how much buffers are required for the market risk, this will depend upon that what is the potential loss under the stressed market condition. If the stressed market condition come, if the market condition is very volatile, it is going towards a downward trend. So if a stressed market condition is coming, what is the potential loss that the RBI can face? So that is the risk, the potential loss that the RBI can face. This is the market risk. On the basis of the market risk, the buffers will have to be maintained by the RBI. So while the requirement, now the market risk is calculated, or the market risk is assessed on the basis of expected shortfall, the potential loss that the RBI can face under the stressed condition. Then this, I hope, is clear that the market risk, it is assessed, it is calculated, it is seen using the expected shortfall, that is the potential loss under the stressed market condition. Now, how, in what criteria the buffers will be maintained? So central board would have the flexibility. Now this is the main idea. This is the revised framework. So under the revised framework, as per the internal review, central board would have the flexibility to maintain market risk buffers at any resilience level. So usually in economics, we have this bell-shaped curve. Here the confidence level is given. So this is the confidence level of 99.5%, and this is the confidence level of 97.5%. Okay, so that means, let's say if a risk is coming, let's say if the risk is coming, this is the risk in the economy. If the risk is coming, this is the market risk. So this is the risk. So the buffers are having the high, the buffers that are being maintained, they have the high safety, because a lot of buffers are maintained for the market risk. For the market risk, 99.5% means this is the high confidence level. The RBI is very confident that the RBI will able to handle the problem, because a lot of buffers are maintained. This is the buffers that are maintained. This is the, so at the high confidence level. Now let's say that the buffers are not maintained at the 99.5%, the buffers are maintained at this level, that is 97.5%. At this level, the buffers are maintained. So if the market risk are coming till here, so buffers, 97.5% of the buffers are maintained at the 97.5% of the confidence level. That means moderate safety is there with the RBI. So this is the basic idea. So here, this is the 99.5% of the confidence level. This is the high confidence level, where if the market risk come, so only a very small portion of the market risk will not be tackled, but most of the market risk will be tackled. So 99.5% of confidence level shows the high safety, very high safety. The RBI is very confident in maintaining the market risk, and there is high safety that is present in the economy. The 97.5%, this 97.5% of the confidence level, this shows that the market risk can be maintained with the RBI, but at the moderate safety level. At the moderate safety level, some of the market risk will affect the economy, but not much. So market risk can affect the economy, but not much. The RBI will be able to maintain the buffers. Now, at which level will you want to maintain the buffers? At which level? Just think about it, that if you feel that in the future a big problem is going to come in the economy, a huge market risk is going to come in the economy, so at which level will you want to maintain the buffers? At the 99.5% or 97.5%? Just think about it. At what level will you want to maintain the buffers? Just tell me at which level. So I would maintain, if I feel that in the future a lot of market risk can come, I will maintain the buffers. I will start maintaining the buffers at the 99.5% confidence level, so that I have the high safety. Okay. So this is the idea, that central board would now have the flexibility to maintain the market risk buffers at any resilience level within the range of expected shortfall at 99.5% confidence level and expected shortfall at 97.5% of the confidence level. So 99.5% of confidence level will show that there is high safety. So 99.5% of confidence level is high safety, 97.5% confidence level is moderate safety. Okay, so the RBI has the flexibility to choose between them, between these two confidence levels. Okay, so this is the idea, to maintain, as well as the RBI will have the power to maintain the risk provisions for the shortfall in revaluation balances. Now, this is a very, very important point that you will see in the coming slides also, that for the market risk, there is a special kind of buffer that the RBI has to maintain, that is known as revaluation balances. Revaluation balances. For the other kind of risk, this balance cannot help. For the other kind of risk, even if the operational risk is coming, even if the credit risk is coming, the revaluation balances will not be used in that case. Only in the case of market risk, the revaluation balances are used. So keep this in mind very clearly, that for the market risk, the revaluation balances are used. Okay, for the market risk, the revaluation balances, because if the risk is coming, how to maintain the buffers? From where the buffers will come? So buffers will come from the revaluation balances. Okay, so the RBI will have the flexibility, the central board of the RBI will have the flexibility to maintain the risk provisions, to maintain the provisions for the risk, for the shortfall in the revaluation balances. So RBI will have the flexibility that at 99.5% of the confidence level or at 97.5% of the confidence level, the RBI will be able to maintain the provisions for the shortfall in the revaluation balances. Accordingly, based on its assessment of the expected market risk factors for the future risk, the RBI can maintain the enough of the provisions in the revaluation balances as per the confidence level. Now, previously, what was the case? If this the RBI has recently adopted, or recently it has been reviewed, so what was the previous case? In the previous case, the additional risk provisions that can go to the revaluation balances was permissible only if the revaluation balances are lower than 97.5% of confidence level. So that means only for the moderate safety, the RBI could maintain the buffers. RBI could not maintain buffers for the high safety. Now the RBI will also be able to maintain the buffers for the high safety. That's why this flexibility is provided to the RBI. That's why this review and the change has been done by the RBI. Any confusion here, anyone? Okay. So now the range is 99.5% as well as 97.5% of the confidence level. Before it was only at 97.5% of confidence level. So basically the idea is that the RBI can add the risk provisions in the revaluation. The RBI can add the risk provisions in the revaluation balances. The RBI can add further provisions in the revaluation balances as per the confidence level that RBI wants to maintain, high safety or moderate safety. Got it? Now coming to the next point, with respect to monetary and financial stability risk. Okay, so now what has happened? Very basic now, just the numbers will come. So range for buffers for monetary and financial stability risk has been widened. So before, the buffers for the monetary and financial stability risk was within the range of 4.5% of the balance sheet or the 5.5% of the balance sheet. Okay, so this was the range. Previously, this was the range that was provided for the monetary and financial stability risk. But now the range has been further widened and the flexibility has been provided to the RBI, in which the RBI has said that now the monetary and financial stability risk will have the buffer of 5.0% plus minus 1.5%. That means the range has been widened from 3.5%, that is minus 1.5% of the 5.0%, and plus 1.5% of 5.0%, that is 6.5%. So now the range, you can see that the range has widened from 3.5% to 6.5%. So previously for the monetary and financial stability risk, the RBI can maintain the buffers of 4.5% to 5.5% of the balance sheet of RBI. But now it has been said that the range for buffers for monetary and financial stability risk has been widened to 5.0% plus minus 1.5%. So plus 1.5% will be 6.5%, minus 1.5% will be 3.5%. So you can see that there is a huge flexibility that is provided to the Reserve Bank of India. RBI can maintain the highest of the buffers at 6.5% of balance sheet, or if the RBI do not want to keep the buffers and the RBI think that the future conditions are quite stable, so RBI can maintain the lower buffers also. So this flexibility that is provided, so this is providing adequate flexibility. This change in the range that has happened, this is providing the adequate flexibility through the central board in determining the buffers, taking into account the prevailing macroeconomic and other factors. So previously for the monetary and financial stability risk, there was the range of 4.5%. The buffers can be maintained within the range of 4.5% to 5.5% of the balance sheet. But now for the risk, the buffers can be maintained within the range of 3.5% to 6.5% of the balance sheet. So that is 5.0% plus minus 1.5%. This is the range that is provided now. This is the flexibility that is provided. So here, the central board may maintain the monetary and financial stability risk buffer at any level between the range of 3.5% to 6.5% based on its assessment of the prevailing macroeconomic and the financial and the other factors affecting the balance sheet of the RBI. This is providing adequate flexibility to the central board while also smoothing the transfer of surplus to the government. Okay, so when the RBI feels that right now there is a lot of surplus that is going to the RBI, or right now if a lot of money is going to the government of India or a lot of income that has been generated by the Reserve Bank of India, so RBI can also maintain higher buffers, because RBI thinks that we have earned a lot, so we can maintain higher buffers for the future, when for the problem that can come in the future. Okay, so consequently, now see, in the contingent risk buffer, these buffers, now market risk buffer is the revaluation balances. Revaluation balances, they will provide for the market risk. Now this contingent risk buffer, this is for what kind of risk? So this is for all the other kind of risk. That is for the credit risk, the market risk, the monetary and financial stability risk. Okay, so the contingent risk buffer, which includes the buffers for monetary and financial stability risk, credit risk and operational risk. Sorry, market risk is not here, because you know that market risk, the revaluation balances, they provide for the market risk, right? So the contingent risk buffer, it provides for the credit risk, operational risk and the monetary and financial stability risk. Okay, so remember that the revaluation balances are the buffers for the market risk, while the contingent risk buffer is the buffer for the credit risk, operational risk and monetary and financial stability risk. Okay, so these kind of the contingent risk buffer would be maintained in the range of 6.0% plus minus 1.5%, because as you can see, the monetary and financial stability, for that, as you can see that for the monetary and financial stability, the buffer range has been changed. So for the contingent risk buffer, before the range was 5.5% to 6.5%. But now for the contingent risk buffer, the range is decided, that is 0.6% plus minus 1.5%. So that is 4.5% to 7.5%. Understood? So this is the new range that is present for the contingent risk buffer. If the RBI wants to maintain the highest buffers, the RBI will maintain it at 7.5% of the balance sheet. If the RBI wants to maintain lower buffers, the RBI will maintain it at 4.5% of the balance sheet. So this is the idea, that the new range for the contingent risk buffer is 6% plus minus 1.5% of the balance sheet size. Before, the range was 5.5% to 6.5%, but now the range is 4.5% to 7.5%. Any confusion in the range, this is what you have to cram in this. I hope this is clear. Okay, now coming to the next point, that with respect to surplus distribution policy, now this slide is this is the last slide of the first topic. So this slide is the most difficult one. If you understand this, that means everything is clear. Okay, so here, try to understand that contingent risk buffers have to be maintained. Let's say that RBI has decided that for the 2024-25, the contingent risk buffers will be maintained at 7.5% of the balance sheet. Correct? This is what the RBI has decided actually. This is what the RBI has decided. Now, from where the buffers will be maintained? For the market risk, for that, the buffers are maintained in the form of revaluation balances. But for the contingent risk buffers, how the buffers are going to be maintained? From where the fund is going to come, or from where the capital is going to come for the contingent risk buffer? So this is going to come from available realized equity. This is going to come from the available realized equity. Available realized equity, this consists of the funds of the RBI. This consists of the capital in the form of capital fund, in the form of reserve fund, in the form of contingency fund, and in the form of asset development fund. Okay, so basically the contingent risk buffer, if RBI has said that for the 2024-25, for this financial year, for the previous financial year, the contingent risk buffer is 7.5% of the balance sheet. So how this buffer is going to be maintained? So that will be maintained, the funds will come from the available realized equity, that is in the form of the available realized equity. This is maintained in the form of capital fund, reserve fund, contingency fund, asset development fund. So these are the funds that are present in the available realized equity to provide for the contingent risk buffer. Is this clear or not? Is this clear or not? So in the contingent risk buffer, from where the funds are going to come? So they are going to come from the available realized equity that is maintained in the form of capital fund, reserve fund, contingency fund, asset development fund. I know my handwriting is the worst, but that's why I am repeating it, that what they are. Okay, as available realized equity, this consists of or the available realized equity, this is the money, this is the fund, this is the capital in the form of capital fund, or this consists of capital fund, reserve fund, contingency fund, asset development fund. Okay, so available realized equity, this is the capital, this is the fund, this is that is maintained with the RBI in these four ways that helps in that provides for the contingent risk buffer, okay. So I hope this is clear. What is ARE? So ARE is the available realized equity. It is the available realized equity. This is the fund or money that is available with the Reserve Bank of India in the form of capital fund, reserve fund, contingency fund, asset development fund. Now this available realized equity is providing for the contingent risk buffer. I hope this is clear now. Now coming to this, so see, the ECF, the Economic Capital Framework, it establishes the principle of one-way fungibility. One-way fungibility means one-way transaction can happen, or one-way amount can be transferred only. One-way fungibility, implying that revaluation balances. Now revaluation balances is for what? Revaluation balances is for your market risk, right? It is for market risk. So Economic Capital Framework establishes the principle of one-way fungibility, implying that the revaluation balances can provide only for market risk. The revaluation balances can only provide for the market risk, while the realized equity, that is the available realized equity, that is the ARE, that is the available realized equity, that is the fund money that is available with the Reserve Bank of India, it can provide not only for the monetary and financial stability risk, the credit risk and the operational risk, but also for the residual market risk. That means, let's say you have the revaluation balances of 100 rupees, but for the market risk, you require 110 rupees. For the market risk, you require 110 rupees. So revaluation balances are lesser than what is required for the market risk. So this 10 rupees, that is the residual market risk. This can be provided through the available realized equity. So available realized equity, this is the available money with the Reserve Bank of India in the form of capital fund, reserve fund, contingency fund and the asset development fund. So this money can be used. This money is prominently, and first thing is, this money will be used for the contingent risk buffer. For the contingent risk buffer, is what? Contingent risk buffer is the market that maintains for the monetary and financial stability risk, credit risk and operational risk. So the available realized equity, it will provide for the contingent risk buffer, or it provides for the contingent risk buffer for the monetary and financial risk, operational risk and your monetary, operational and the last one is credit risk. While the available realized equity, it can also provide for the market risk, for the residual market risk that is not being provided by the revaluation balances. Got it? Is this clear? Clear? Okay. So with respect to the surplus distribution policy, see, the RBI earns the income. The RBI is providing the loans, the RBI is getting the repo rate, or the RBI is getting the interest. The RBI has bought the securities, from that the regular interest is coming. So RBI is earning income from various sources. RBI is earning the income from various sources. Now from this income, the RBI will pay for the operational expenses. Operational expenses like paying your salaries, because you will become the RBI Grade B officer or the RBI Grade A officer. So RBI will have to pay your salaries. So these are the operational expenses, the day-to-day or the regular expenses of the RBI. After the expenditure, from this income, the RBI maintains the contingent risk buffer. Then whatever, after taking into account its expenditure, after maintaining the buffers, or not the contingent risk buffer, we can say it is the available realized equity and for the contingent risk buffer and the revaluation balances. Then whatever is left, that is transferred to the government of India. So whatever surplus is left after that, that is transferred to the government of India. Okay. So the available realized equity or the provisions the RBI maintains for this. Okay. So this is the idea. Now, with respect to the surplus distribution policy, any available realized equity in excess. So basically, any available realized. So let's say available realized equity, if the contingent risk buffer that has to be maintained at 7.5% of balance sheet, so that means available realized equity after considering or after providing for the shortfall in the market risk buffer. So the available realized equity after considering or after providing for the shortfall, in the market risk buffer, the available realized equity should also be 7.5% of the balance sheet to meet the contingent risk buffer. So available realized equity, this should provide for the contingent risk buffer, but this also provides for the residual shortfall in the market risk buffers, right? So available realized equity after considering the shortfall in the market risk buffers, after that has been provided, then the available realized equity, if the contingent risk buffer is 7.5% of the balance sheet, the available realized equity, the money, the capital, that should also be 7.5% of the balance sheet. Okay. Now this, if let's say in the available realized equity there is more money or there is more capital as compared to 7.5% of the balance sheet. So what will happen to this higher amount that is present in the available realized equity? So this may be written back from the contingency fund to the income. So available realized equity, this consists of the capital fund, reserve fund, contingency fund. So from the contingency fund, so if the available realized equity, it has more money as compared to what it should be keeping for the contingent risk buffer. So whatever extra money is in the available realized equity, that should go from the contingency fund of the available realized equity to the government, or to the income part, or to the income, in the income. Okay, this is the idea. This should go to the income. In case the available realized equity, let's say, in case the available realized equity, it is less than the lower bound, of its requirement. That means available realized equity, the lower bound is for the contingent risk buffer, the bound is, or the range is 4.5% to 7.5%. So if the available realized equity is below the lower bound of its requirement, no surplus. That means if the contingent risk buffer, let's say the RBI does not have enough available realized equity to maintain the contingent risk buffer at 4.5%, that is the lower bound. That means the RBI do not have enough buffers. It is not even able to meet the lower bound of the contingent risk buffer. So in this case, the RBI will first think of replenishing its capital, will first think of maintaining the buffers, and so no transfer or no surplus transfer will happen to the government of India. This is the idea, that if the available realized equity is below the lower bound of its requirement, that means the RBI do not have enough buffers. First, RBI will be making its buffer, filling its buffer. So no surplus will be transferred to the government of India till the at least the minimum level of required realized equity is achieved. So at least the minimum level of realized equity should be met. Okay. So this is the idea. Got it? So available realized equity, this is the total amount of realized equity, this is the total amount of capital or the fund that is available to meet the risk, to meet the monetary and financial stability risk, credit risk, and the operational risk, as well as the residual of the market risk buffers, and help RBI decide how much surplus can be transferred to the government of India. If the available realized equity is very, very less, and it is not able to meet the contingent risk buffer of the lower bound, so the no surplus transfer will be given to the government of India, because the available realized equity is very less. But let's say available realized equity is very high, the RBI has very high available realized equity. So in that case, the money will go from the contingency fund, of the available realized equity to the income part of the RBI. Okay, so this is the idea. So this revised framework comes into effect from the financial year 2024-25, that is from the previous financial year. So now, till now, everything is clear. So this is the first part. Okay. Now coming to the next part, that is 616th meeting of the Central Board of Reserve Bank of India. This was conducted. So 616th meeting of the Central Board of Directors of the Reserve Bank of India. This was conducted on 23rd May. And this was held under the chairmanship of Shri Sanjay Malhotra, the Governor of the Reserve Bank of India. The Central Board reviewed the global and domestic economic scenario, including risk to the outlook, including risk to the future situation in the country. The board also discussed the working of the Reserve Bank during the financial year 2024-25. So the previous financial year has finished, and that's why the Central Board has discussed regarding the working in the previous financial year, and the RBI has approved, or the Central Board of RBI has approved the RBI's annual report. So you can understand that soon the annual report of the RBI is going to release, and that's why I have taught the previous topic in detail, so that you have the understanding of the economic capital framework of the RBI. Okay. And the financial statement for the year 2024-25 is also going to soon release. This has been approved by the Central Board of the Reserve Bank of India. Okay. The transferable surplus for the year 2024-25 has been decided on the basis of the revised economic capital framework. So in the revised economic capital framework, can you tell me that what is the range in the revised economic capital framework? What is the range for the contingent risk buffer? Okay. So this is the idea. The transferable surplus for the year 2024-25 has been arrived. So the surplus that will be transferred to the government of India, that has been decided on the basis of the revised contingent risk buffer, on the basis of the revised economic capital framework as approved by the Central Board in its meeting held on May 15, 2025. So revised framework stipulates that the risk provisioning under the contingent risk buffer will be maintained within the range of 4.5%. So you know that the contingent risk buffer as per the revised economic capital framework is within the range of 4.5% to 7.5%, that is 6% plus minus 1.5%. Okay. So now within this range, the contingent risk buffer has to be maintained, and the RBI has decided to maintain the contingent risk buffer for the financial year 2024-25 at 7.5%. That is, the RBI has decided to maintain highest ever buffers. So during the accounting year 2018-2019 to 2021-22, owing to the prevailing macroeconomic conditions and the onslaught of the COVID-19 pandemic, the board decided to maintain the buffers of 5.5%. Now try to think about it. Let's say that right now the good times are there. The market risk is very less, monetary risk is very less, operational risk is less, credit risk is less. In this time, the RBI will maintain low buffers or high buffers. What do you think? In the good times, the RBI should maintain low buffers or high buffers. In the good time, actually, the RBI should maintain high buffers, so that in the bad times, the RBI will be maintaining the low buffers, and in the bad times the money will be used. Okay. So always in the good times, whenever, like if you are unemployed, let's say, at that time you will maintain low buffers. When you are employed, when you are earning 1 lakh, 2 lakh, 3 lakh per year, then you will start saving that, okay, I have to save for my future. What if the bad time comes? So whenever you are in the good times, always you save more. Similarly, the RBI is also doing that. Right now the good times are there. We do not, like, COVID-19 has finished, Russia-Ukraine war is not creating problem for us now, and the geopolitical situation is somewhat like stable now. If you see the financial market of our country, the share market has started to revive. So you can understand that right now we have a stable situation as compared to the previous years. Okay. So in this time, the RBI has decided to maintain the highest ever buffer. The highest ever buffer of the highest ever contingent risk buffer of 7.5%. So during accounting year 2018-2019 to 2021-22, owing to the situation that was at that time, the RBI maintained only the contingent risk buffer of 5.5%. That was quite low of the balance sheet of the Reserve Bank of India to support the growth and overall economic activity. So RBI maintained less buffers, RBI spent more, RBI gave more surplus to the Government of India from its income, okay, and maintained less of the buffers. Now the contingent risk buffer, it was increased to 6% for financial year 2022-23. Slowly and slowly, as RBI thought that, okay, now the conditions are becoming more stable, so RBI started to increase the contingent risk buffer, and for the financial year 2023-24, the contingent risk buffer was maintained at 6.5%. Now the RBI, as per the revised economic capital framework, the RBI has considered and has decided, the Central Board of RBI has decided to further increase the contingent risk buffer to 7.5% for the 2024-25. And even after maintaining such high buffers, the RBI has transferred the highest ever surplus to the central government. So from its income, even after maintaining the highest ever buffers of 7.5% of the balance sheet for the 2024-25, even after maintaining such high buffers for the financial year 2024-25, the RBI has done the highest ever surplus transfer to the Government of India of 2.69 lakh crore. So you can understand that this is the good time. So we are maintaining more buffers, but at the same time we are able to transfer, or RBI is able to transfer, a lot of surplus to the Government of India. Any confusion here? So this is it. So the board thereafter approved. So the board decided to further increase the contingent risk buffer to 7.5% of the balance sheet, and the board thereafter approved the transfer of 2.69 lakh crores as surplus to the central government for the accounting year 2024-25. Okay. So this is Perspective 360. So in this, on Monday, I am taking your Perspective 360 session for your answer writing, and on Tuesday and Wednesday, on Wednesday and Friday, Jaskaran sir is taking the session of your answer writing. Okay. So these answer writing sessions, they are going to help you a lot, because first of all, they will teach you how to write the answers, what are the important topics that are going on currently on which you should be writing the answer, as well as these answer writing sessions, they are conducted at 5 p.m. and they also provide you a question. So in these sessions, we provide you a question for which you can write the answer, and that answer is evaluated within those answers are evaluated by the team if you answer within 48 hours. So you also get the free evaluation in the answer writing series. Okay. Now this is the first question. I hope you will be easily able to answer this question. So I hope you will be easily able to answer this question. This is the first question. You have to tell that which of the following statements is or are correct in regards to the revised economic capital framework. The second question is regarding the contingent risk buffer. So you just have to tell the percentages of the contingent risk buffer for the 2023-24 and for the 2024-25. Okay. So these are the two questions. Try to answer these, and do tell me if you like the session. And annual report is soon going to come, so we will soon be able to see the annual report. That will be very, very important from your examination point of view, because you can understand that even if the exam happens in July, then also your annual report that has just come 2 months before or 1 month before, because the annual report might be released on 30th May. So you can understand that annual report will be the most important report for the examination then. Okay. Manish, if I will, like, payment regulatory board, where it has come, can you send me the, like, where it has come in the RBI website, in the press release, in the notification section? So do tell me that where you have seen that. If it is in RBI website or if it is recently in the news, then I will surely take the session. So this is it. I hope you enjoyed the session. This was a lengthy one, but revised economic capital framework is a very important topic. So I didn't want to do injustice to the topic, and that's why I have explained you the details. Okay.